Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. This is just a reminder as well. We are having a Sunday 7 a.m. Mountain Standard Time question and answer session, which is occurring right now. Jump on the call if you're a part of the website and you want to partake in it. So let's dive in here. Let's see what people are talking about with stuff that's related to finance, commodities, and/or wealth building topics. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, we do have a discount going on called LEAP because it is leap year. So LEAP, LEAP. And we have a question and answer session occurring right now if you want to jump over there and partake in it. So platinum outperforming palladium as expected from the bottom, at the bottom of the ratio, where I had swapped all of my palladium for platinum. Gold and silver outperforming as well. I do have large stake in silver. I am a platinum silver junkie. I do have a little bit of gold as well, but silver and platinum are what I am betting on. So these are the ratios. This is platinum versus palladium. When the ratio goes up, platinum is outperforming palladium. It also is an indication of where we are in the cycle to some degree. So there we are, moving on up from a very low level. I think I traded at 0.356, somewhere in there, maybe. We are now about 1. So I've made 3 times the amount of palladium by swapping my palladium at the bottom into platinum. And I'm hoping that I can get something like 10, 11 times, maybe. That would be from a 0.3 all the way to about a 5 ratio. That would be 15. But if I can get 12 or eke something out like that, I would be happy with that. That means every ounce that I swapped palladium for platinum, and when I swap it back, I would be getting 12 ounces of palladium for every 1 ounce of palladium that I swapped into platinum at the bottom of 2020 in April. Pretty good mix, if that occurs that way. This is gold versus palladium. Gold is outperforming palladium. Palladium's going down in relationship to all these other metals. And then we've got silver, and silver's also outperforming palladium. So palladium was expensive, so was rhodium against all the other metals at the bottom of 2020 in terms of the ratios. At the bottom of the market, I should say, in 2020. So what I would have done and what I've done is I swapped my metals into the undervalued metals, and I'm waiting for this ratio to get to an overvalued state. Now, I want to make something completely clear. I can be swapping metals, and let's say I swap into, I'm just going to make this up, gold. And gold doesn't trade anywhere. But the metal that you traded out of, let's say palladium, and palladium goes down against gold and gets all the way to a level that's up here, and I swap it back into palladium. The question is, did I make purchasing power gains? My answer would be yes. You made purchasing power gains when comparing these two metals, even if gold goes nowhere or goes up very small amounts. So let's say gold goes up a small amount, palladium goes way down. You swap your metal back and you increased your ounces of palladium. You made purchasing power gains against palladium. And then eventually, when I went back and looked and did all the research and all this stuff, at some point, because the system is inherently inflationary, all of the metals get repriced higher over a long period of time. So I use it as a savings account, and I overweight the metals that are favorable from a ratio perspective. Inflation will carry the pricing of all these metals higher. And if you hit any sort of energy problem or a problem with mining in terms of ore grades and finding deposits, you also are protected against that because the cost curves will continually go up. So the mining companies may not make any more money, but the price of the commodity itself will continue to go higher, adding, hopefully, purchasing power gains. Let me move this a little bit bigger there. There we go. Going on down, Gary Savage, he says, we often hear that the rich are getting richer at the expense of the little guy. The Fed prints money and it goes straight to the billionaires and millionaires. Of course, it's complete nonsense. Anyone who has a 401k invested in the market is profiting from rising stocks just like billionaires. The rich aren't extracting wealth from the little guys. The rich create businesses that sell products to the little guys. No one forces you to buy their products. If they provide a great product or service, you are willingly giving them your money in exchange for that product or service. That's the main difference between rich people and poor people. Rich people build businesses and buy appreciating assets. Poor people throw their money away on depreciating liabilities and worthless toys. If you want to stop being poor and become a rich person, then stop doing what poor people do and start doing what rich people do. Save your money, start a small side business, start investing in things that will make you money instead of throwing your money away, trying to impress your friends that you have the latest and greatest doodad. He's completely right. There's nothing wrong there. And another thing is, it's a mindset too. If you want to make money, it's a mindset. Money is an accumulation of unspent wealth. Money is an accumulation of unspent wealth. And if you want to be wealthy, you can't spend it. You have to accumulate it. So you have to provide utility to the market in greater quantities than what you are extracting out of it, is what I'll say. German deindustrialization didn't start with an energy crisis. Politicians and unions have been relentlessly working to make Germany less attractive for investment for many years. I would disagree. A lot of it does occur with energy. Energy is the cornerstone of GDP if you were to look at it from a linear regression analysis. Energy growth and GDP are tied together. I'm a manufacturing engineer. I would see this firsthand in world-class manufacturing. As we progress technology forward, technology is more or less just a conversion of energy into usable products. They're taking energy and commodities and converting it to usable products through machinery. And I would program machines. I would program the robotic arms. I would watch these things uh, basically play out in the uh, in the manufacturing facilities. So labor is becoming less of a portion of the actual production of goods, and energy and machinery are taking a larger and larger portion to create GDP and to create things of value. So energy is an important cornerstone of GDP, and it's becoming more and more important as time progresses. Coming down, I'm a great believer in the cyclical nature of the markets, but I never cease to be amazed at how far they can go in one direction and for how long. The extremes, and for how long that the extremes can reach. Despite logical arguments to the contrary, and the swiftness of the swing back. So basically, he's just saying markets are cyclical and he can't believe how overstretched they can become. And I think that we are in that overstretched time frame with technology stocks. Their days are limited. And I think we're going to get a swiftness of the swing back at some point. Norway is the poster child for electric vehicles or cars. Government subsidies pushed EV sales from essentially zero to over 80% of new vehicle sales in less than 15 years. Despite the growth of EVs, oil demand has not decreased. So Norway oil demand, you can see gasoline just ripping it to the upside. There's 2024 estimated. And then non-gasoline over there. And then the total continues to go up because that is a growth percentage. So these guys are the furthest along in terms of their electric vehicle adoption, and it has not gone negative for oil consumption of that country. Very interesting in terms of oil and how hard it's going to be to decrease oil consumption. Kiwi Infinity says, is there anything more annoying than taxes? Leave my money alone. I completely agree. I hate taxes. I hate them. They got to make this system more simple. They really do. If you want to be rich, prioritize like the rich. Number one, needs. Two, investments. Three are the wants. Got these in the wrong order and you'll be broke. Satisfy your needs, investments, wants if you want to be rich. Manias are temporary, fundamentals are forever. Manias are temporary. And what are we in? We're in a mania. We're in a mania for technology stocks. It's going to be a reckoning. Average income by age. How do you compare? So 31,000, 36,000, 52,000, and 62,000 between 35 and 44. Where are you located in relationship to the average income by age? Just curious. Taking original capital off the table with winners will cost you a lot in the long run. Never trim asymmetry. Position size correctly and then leave it the F alone. Never trim. Do not take your original capital off the table with winners, and it's going to cost you in the long run because of the asymmetry if you're in these types of investments. We know someone who's been trimming. Pretty popular. He trimmed uranium just recently. I'm not interested in cars, and my goal is not to make people envious. Don't confuse the cost of living with the standard of living, says Warren Buffett. And I do think a lot of people confuse this. I can drive a very old vehicle, and it essentially functions the same as a brand new shiny object vehicle that costs a lot of money. The standard of living is the same, but one is a lot higher cost. So you can live in a little bit bigger house in a little bit bigger, little bit different neighborhood, and it's not really going to make that much of a difference. Now, there could be a dramatic difference between something that is like a really rough neighborhood that maybe has poor schools for your kids versus maybe a better neighborhood. But what if you're already in a better neighborhood and your house is meeting all the needs that you really have and want versus a house that is twice the cost, but maybe on 5 acres somewhere else? I don't think your standard of living is going to increase that much. That's more of a want than a need. While everyone is plowing into tech, Warren Buffett doubles down on big oil amid tech-crazed market. BP surprises with earnings investors. Warren Buffett doubles down on big oil. That's where I'm going, guys. Oil is going to be a big winner, and tech is going to eat it when oil starts to go up, I think. Are we there yet? Maybe not. Maybe it takes a little bit of time, but I'm patient enough. Where you get really hurt in investing is when you chase price and the value is not there, and then it reverses on you. That's where you get hurt. If you don't want to get hurt, you buy value and let the price come to you. But you have to be patient. So you buy what's undervalued and what people don't want, and then you wait for the price to come to that valuation. And then you wait until the sentiment changes in kind of a euphoria thing, and that's when you sell. You get out. Some of the most negative, pessimistic people I know are also the most broke. You could probably say that for a lot of things, but I would say a lot of, not all of broke people, but a lot of broke people are very negative and pessimistic. Probably don't like their life and they don't want to get up and change their attitude, which then changes their position of being broke. The top 1% of each age bracket, and this is a lot of money. It's not too much money. It's a good amount of money. I look at 40 to 44. That's where I fall. 3.25 million bucks. That's pretty good. 45 to 49 is 5.2 million. 80,000 if you're between 25 and 29. So, and 400,000 between 30 and 34. And then you can see how compounding works in your favor. Basically, a big chart of compounding. Gitzel guided 22.4 million pounds attributable for 2024. That's CAMECO's CEO, I think. They're contracted for up to 34 million pounds. Even if the challenges get solved and they get MacArthur to that 25 million pounds, 100% basis, it'll still be challenging to service those contracts without the spot market. It's a pretty tough situation here. They really got to, I mean, if they've contracted 34 million pounds and Gitzel guided 22.4, that's a big gap. That's a big gap that they got to go buy out at spot if they can't get their um, their production in line here. Everyone is gambling at the penny stock casino. You can see penny stock trading soars. It seems as inflation keeps getting worse, maybe the desperation continues to go up, and people are trying to trade more in penny stocks. But I do own a couple penny stocks in the uranium sector myself. Let me tell you this. This is my Baba and K-Web friends. Xi Jinping and the CCP are going to pump the crap up out of Chinese stocks during the year of the Wood Dragon. Mark my word. So maybe Baba is a good spot. I don't know. Baba is really cheap, guys. It is really cheap. It is a very, very good value. Just in, Jeff Bezos sells 2 billion of Amazon shares in first major stock sale since 2021. This guy knows what's going on. Bubblelicious. I'll skip that. Tech is more than 1/3 of the entire US stock market's capitalization, the most since 2000. Here we go in bubble land, boys. And it could extend further. I'm not saying it can't extend further, but we're in a bubble. Amazon Bezos sells at least 2 billion worth of shares. Says the guy is a Hall of Fame seller, dumping his shares at the top. And there he is selling up here 10.2 billion, 6.6 billion, 2.2 billion. He's starting to sell as the price continually goes up. He is cost averaging out. Zuckerberg and Bezos literally dumping hundreds of millions worth of stock, the most they've sold in years. But I'm sure you'll be fine with the shares you bought last week. You'll be fine. Don't worry. If you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing. It makes little things grow big and big mistakes fade away. Grow your time horizon. And I actually talk about this quite a bit in a lot of our question and answer sessions. The S&P 500 is an absolute runaway train. Is there anything that could possibly stop this momentum? Something will. I don't know when. So, almost a decade before he became a household name, a young Michael Burry put his strategy into words on an online forum. I just wanted to read his isn't very complex. I try to buy shares of unpopular companies when they look like roadkill and sell them when they've been polished. All of my stock picking is 100% based on the concept of margin of safety, as introduced to the world in the book of Security Analysis, which Graham co-authored with David Dodd. Specific known catalysts are not necessary. Sheer outrageous value is enough. AKA, I started my channel in a very similar approach to this strategy as well. It's to find the value. And that's the name of the website and the name of my YouTube channel, Finding Value Finance. So that's the same approach. You take out of favor stuff, buy it, and then wait. that's just exactly what Buffett and Peter Lynch and all these other guys have done. For production, even if producers cut back on drilling, nat gas output is still expected to rise because of oil demand. So because of oil demand, they're going to produce the oil, and natural gas comes with it, is what I'm seeing here. Encouraging producers to seek more oil in shale basins. The collapse of gas prices this week also elevated the oil to gas ratio to its highest since May of 2012. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. And that could occur. And I know on the website, I talk a lot about risky companies. This is what I mean by risky companies. It's this. Peter Lynch is telling you never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. All I'm going to say is, I know I've got a lot of uranium investors. Look at their balance sheets. They do not look that great. They can still make you a lot of money, but you're taking on risk. That's all I'm going to say. NVIDIA wants to add a large U.S. city to the power grid every single year. Yep, very sustainable growth. So let's go over this. And this is, actually, let's read it here. This is NVIDIA's H100 GPU. It has peak power consumption of 700 watts. At a 61% annual utilization, it is equivalent to the power consumption of the average American household occupant based off of 2.5 people per household. NVIDIA's estimated sales of H100 GPUs is 1.5 to 2 million H100 GPUs in 2024. Comparing to residential power consumption by city, NVIDIA's H100 chips would rank as the 5th largest in terms of power consumption, just behind Houston, Texas, and ahead of Phoenix, Arizona. And they're pumping these things out every single year with the power consumption of the 5th largest city in the United States. That is the gravity of how much power AI is going to consume. And it's probably going to go up because not just NVIDIA is going to make this, but a bunch of other chip makers eventually will start to make this. How much power are we going to try to consume in the next 10 years? I mean, we are going to be putting up cities and cities and cities worth of power. And what's going to generate this? Right now, the largest growth in electrical generation is natural gas. We need to get nuclear up and running very quickly, and or fusion. And that's where I'm going to end it at. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We're doing our question and answer session right now. So if you're a member, jump on, ask me whatever questions, or listen to what other people have to say on their questions. So thanks for listening. That's all I've got. We'll catch you next time. This is Finding Value.